So according to the latest figures, UK house prices hit £295,903. That's from the latest government data. However, there's definitely some cracks starting to show, and data from Nationwide, who are one of the biggest providers of mortgages in the UK, are actually suggesting that prices have actually fallen for the first time since last month, actually dropping 0.9%. Now that might not sound a lot, but it's actually the biggest fall monthly since July 2021, and it's the biggest fall since June 2020. Now this does lead us on to the big question, is this just a blip on the road, or is the kind of unstoppable rise of housing prices in the UK about to come to an end, and we're going to see some sort of crash in the housing market? Because surely things can't just keep going up and up forever, or can they? I think talking about housing in the mortgage market is probably one of the most interesting topics, because if you asked anyone on the street, they'd say that investing in bricks and mortar is probably one of the most secure investments you can make. And I guess it's not really a surprise when you actually look back at the long-term price chart from around 2005 or so on this data. You can see since then, house prices have actually nearly doubled to where they are today. And I think the most impressive thing, of course, when you think about that stat, is that that's happened even through a great financial crash. And actually, if you work out the average price increase from 2005 to where we are today, that actually sits above 4% on a compounded annual growth rate, which seems pretty good to me. So definitely good if you've managed to hold on to some bricks and mortar during that time. However, a little bit annoying for people that have tried to get on the ladder, because ultimately more than 4%, that's twice as much as what the Bank of England want as their inflation rate. So anything going above and beyond 2% a year is definitely going to start getting out of reach for a lot of people. So the reason I wanted to make this video really all comes down to the fact that interest rates have been rising so quickly, and then of course we've got inflation out of control currently in the UK. And this is putting a huge amount of pressure, firstly on people that want to get on the property ladder as first-time buyers, but then also all of us who maybe need to remortgage in the next couple of years, and we've all been getting used to really, really low rates of kind of below 2% or so. In fact, all of that in, then add on all the cost of living pressures that we're seeing at the moment with energy prices going up through the roof, are we headed toward one of the biggest crashes in the property market that we've ever seen? Well, before we make any crazy judgments like that, let's just keep our sensible hats on just for the time being. Let's firstly talk about these issues one by one, and we'll go through interest rates first. Now, as you might have seen, the Bank of England just raised the interest rate up to 3%, which was 75 basis points from where they were before. So they were sat at 2.25% before, and now they're at a record high of 3%, a record high at least in the last decade or so. Now, we've not actually seen rates as high as 3% in the UK. We have to go all the way back to the great financial crash, and they were actually 3% around the end of the financial crash, or during the financial crash, when rates were actually coming all the way down. But since then, of course, as most of you will know, rates have been so low, and basically money's been pretty much free to borrow. Now, if we go back a little bit further, of course, we can see that 5.75% was actually the peak just before the great financial crisis actually hit the UK, and that was as high as interest rates actually got. Now, those interest rates set by the Bank of England are really key, especially when we look at mortgage rates. Now, of course, every time the interest rate gets risen, the mortgage rates that you'll see out there in the wild, out there in the private market, are of course going to keep going up and up and up, as of course those lenders are going to want to get their premium on top of whatever that base rate is. Now, if you look at some of the best rates out there currently, if you were going to either be a first-time buyer or going to get a remortgage for yourself, you're actually looking right now around 5.75 to even 6.5% from some lenders. Now, without any context, that's not going to make any sense. Let's actually just take some real-world examples and say what that's actually going to make a real difference in the real world. Okay, so let's just go for an example, and I'll put this on screen now. If we assume we've got, say, a £200,000 mortgage left on our home and then 25 years left to pay, with an interest rate of around 2%, we're paying around £848 a month. Now, if you change that rate to 6%, things start to get a little bit crazy, and your monthly payments go up to £1,289. That's more than a 50% jump in that payment from that original number. So right off the bat, that leaves us with a couple of really big issues. First-time buyers especially, they're either going to have to increase their deposit massively or reduce their budget by a huge amount. But there's only so far they can reduce their budget, because of course you may not even get a house, even find an average house price, if they're going to increase so much. And again, just keeping on those examples, let's say if we did want to keep our costs below £900 a month in that same example, let's just say because that's what our budget is, we'd only actually be able to borrow £135,000 on a 6% interest rate compared to nearly £200,000 if we had a 2% interest rate. So when you consider it from a buying power perspective, our buying power as a first-time buyer is being reduced by 30% or around that kind of number when we're trying to keep the budget the same. Now, the reason that's so important for first-time buyers is because first-time buyers make up around 50% or so of the overall market. So if first-time buyers can't get on the ladder and help keep those property prices high, well, unfortunately, something else has to happen to that whole supply and demand in the market. So that means you can pretty much make a well-educated guess and say, if there's no more demand in the market and the supply remains the same, There's only one thing that could possibly happen to those prices. Now, let's also not forget about current homeowners too. Now, I did a community poll recently just asking about all of you and where you were, and lots of you seem to have been fixed in, luckily, for the last few years on some nice low rates, but there are definitely quite a few of you out there who are going to have to remortgage in the next couple of years, and unfortunately, this probably means that you're going to end up maybe paying double or triple amount on your interest rates, especially those of you who managed to lock in below 2%. So again, just run those numbers. If you had, say, £150,000 left on your mortgage with 15 years left to pay, you're still going to go from around £965 to £1,266. That's an increase of nearly 30% there for you, unfortunately. And of course, that's not going to put a lot of people in a good position because lots of households out there definitely don't have £200-300 a month sitting around to be able to pay an additional mortgage. So that does mean probably when it comes to remortgage time, potentially people are going to have to stretch that mortgage out for many more years to try and keep themselves in that budget. But it just means they're going to have to be on a mortgage for many more years. Now, let me just take you back to that Nationwide report, of course, that I was talking about at the beginning, because this whole story isn't about the fact that house prices are more expensive than they've ever been. I mean, you would expect that with inflation. Ultimately, even Freddos and 99p ice creams, everything goes up over time, unless you're talking about some things like technology, which might get cheaper. But generally, things are going to go up more expensive over time. The really big issue, though, is when you say this is expensive, the question you should ask then, okay, is compared to what? Why is it expensive? And the biggest thing when it comes to house prices is really we're talking about affordability. So how much percentage of your take-home pay actually goes toward the mortgage? And this is where things get really interesting. So as you can see on screen now, here's the long-term average that goes back to the 1980s. And this shows what percentage of people's take-home pay they end up paying for their mortgage. So the grey line here shows the long-term average. And it shows that it's around just under 30% is the amount of money which people tend to spend on their mortgage. Now, the key thing here is to focus on is with that rise in interest rate, what does it actually do for affordability? Now, as you can see on this point here, on this red dot that says 5.5% mortgage rate, now at that point, those take-home pay levels start to look pretty dangerous at those levels around the great financial crash. Now, bear in mind already that this data is already out of date because we're already talking, if we look on the market now at the kind of rates that we're getting, we're kind of looking already above 6%. So this little red dot here really should be shifted up even further. And this is definitely going to be a major problem for new first-time buyers trying to get on the market. And just to make things worse, we need to talk about one of the other biggest issues when it comes to affordability, and that's everything currently going on with the cost of living crisis. Now, as we all know, the price of energy that we've been paying has gone up massively over the past few months, and the government's had to come up with a price cap to prevent some people's bills from basically making them bankrupt. Even with that price cap, people are still paying more for their energy than they were, say, a couple of years ago, and that's going to put a huge amount of pressure on everyone's take-home pay and what they can actually afford, especially if they're looking to get on the market or maybe about to remortgage. Now, of course, just to add some more fuel to that fire, no pun intended, those energy costs, of course, feed into everything else that we buy, including food costs you would have seen go up at the supermarkets and all the other costs that we've seen go up around us, which of course all adds up and plays their part. Now, at the moment in the UK, inflation's running at above 10%. So that means that anything that would have cost us around £100 last year is now costing us around 110. So maybe that's the weekly shop or maybe just to fill up the car. So ultimately, everything feeds in together. You've got all your energy costs, all the costs of the cost of living crisis, everything going up with inflation. And that all feeds into a very dangerous place at the moment of what might happen now to the housing market as people potentially are reaching that breaking point where they can no longer afford to pay all their costs. So keeping on that topic of affordability, one area that we need to have a little look at is, of course, the jobs market, because it's all good saying what used to cost us £100 is now inflating and going to cost us on average £110. If our wages also increase with that, then we wouldn't really be a problem. But the issue at the moment is the wages as well that people are being paid on average aren't increasing fast enough to cover those costs of inflation, which effectively is reducing their pricing power. And no doubt for a lot of you, if you do work in the public sector especially, you'll be feeling that pinch over the past few years pretty horribly. Now, one of the key things we can possibly look at here is real wage growth. Now, of course, that's the amount you're paid, but we're accounting for inflation here. Now, it's no good if you say, I've been increased my pay rise by 5%, for example. If inflation hits you with 10%, then your actual real wage growth would be negative 5%. So let me just bring this up on screen now and let's have a look at the latest data. Now, as you can see, long-term trends haven't exactly been great for real wage growth. So although they've been going up, unfortunately, inflation's been eating a big part of that. Now, as you can see on screen, some of the most recent data, unfortunately, with that really high level of inflation, real wage growth has been going down. So people's disposable income and the disposable pay that they'll actually be able to spend on stuff like the mortgage and for the housing market in general is of course going down. And especially as well for first-time buyers who are trying to save for that deposit, when you see things like this cannot be good for the housing market. So the bottom line for all this is quite an interesting one, because at the end of the day, the housing market, just like any other market, is all based on supply and demand. And of course, if there's more and more demand for a set number of houses which aren't really increasing over many, many years, then of course that's going to keep those prices high. But the moment that we get some kind of imbalance, then of course something has to happen. Whether we get a big crash or whether we get a big correction, of course that's up for anyone to guess. Now, saying that, it's an interesting market, of course, because lots of people in that buying and selling and in that supply and demand don't necessarily have to buy or sell. Of course, if you can stay put, you're on a fixed mortgage and you're okay and you're covering yourself, you're not really bothered. What this really hurts, unfortunately, though, is those first-time buyers, especially who wanted to get on the ladder. And as we said before, because they make up such a big set of the market, they're going to reduce that demand significantly. And then, of course, what happens to supply? Again, it all depends on whether people have to move and have to make that decision. Now, also, a smaller part of the market, but certainly an interesting one, is going to be all of those buy-to-let landlords. And no doubt there's quite a few of you out there as well who might have bought a property to rent out. Now, at the moment, with interest rates the way they are, anyone looking to do a property for buy-to-let is no doubt looking at the numbers and thinking there is no way those are going to happen again. And of course, for a long amount of time, buy-to-let has been pretty much a money printing machine. If you're able to put up with the stress of tenants and managing property, certainly you've been able to get money for nearly free from the bank, just a couple of percentage points, and then actually the rent and whatever you get from your tenants has managed to cover that mortgage and you made a profit. But now if you look at the rents that those properties are going to be able to achieve, they probably won't cover any brand new mortgages that you take out now, unless of course you've got loads of stacks of cash that you're able to probably put in for a deposit, but it's certainly going to hurt those yields. So it's going to be very interesting even on that market, which again takes away even more demand if you include first-time buyers and throw them in also with buy-to-let landlords. Love them or hate them, unfortunately they're all part of that same market. So seemingly it would be an obvious conclusion then that house prices have to come down, right? If the demand is not going to be there, there's only one way. Now are they going to crash or correct by 20 to 30%, or even maybe a slower kind of decline, or is it going to be like the Great Financial Crash? Now, I definitely veer away from saying things are going to be like the Great Financial Crash. Ultimately, that's when things were taken a little bit too far. We're not anymore seeing any 110, 115% mortgages out there, and lenders are a lot more careful how they lend to people these days, and they are being more stress tested. But of course, with rates heading toward 6%, that still is going to hurt a lot of people. So the big question is what happens from here? Well, the market is pricing in approximately interest rate rises up to around the 5 and the 5.25% mark sometime in 2023. But at the end of the day, that's all just a complete guess. Now, if that were to happen, that could have some serious negative effects on the economy. And that's what one of the deputy governors at the Bank of England has said, that it would have a huge negative impact on the economy if we did actually see rates above 5%, because of course, mortgages are going to be sat on top of that. So really, everything hangs on those inflation numbers that we've seen in the UK. And if they remain high, then the Bank of England won't really have much choice but to keep rates high to combat them. And if it starts to come down, then we might be able to see the bank either keep rates where they are or slowly start to lower them again. But then can we really see rates heading back down to zero again? And what will they actually settle on? Well, who knows? Ultimately, remember that target of inflation is around 2%, and it all is going to depend on those numbers. Now, I'd definitely be keen to get all of your thoughts and opinions on this one. Certainly let me know in the comment section below. I think housing and mortgages is probably one of the most divisive subjects, certainly on YouTube and certainly in the media, so I'll be very, very interested. On one hand, once you own a property or you're in a property, definitely you want to see your house prices increase. Then as a first-time buyer, you're always thinking, well, I hope the prices crash or are going to be low enough for you to actually get on the ladder in the first place. And actually, it's really, really important, as we've just seen, that first-time buyers have a chance to get on the ladder, because of course, if they're not able to buy, then it will actually suffer for the entire market because they make up such a big part of that market. Anyway, we'll have to wait and see what happens with that one. From my own perspective, in my own opinion, I do think there will probably be some kind of correction, or if not a slowdown. I don't think we're going to have any kind of crash like we did in the Great Financial Crash. I think we're in a very different market there. But can house prices keep increasing at the speed they have been for such amount of time? Probably not. But then also, it's going to be very different depending on where you live in the country. I think we'll definitely see some sort of corrections, but we'll keep an eye on the data. We are going to get some new data out around the 15th and the 16th of November. So if this video does well and you want to see another one, let me know. I'll definitely do a follow-up. But in the meantime, thanks so much for watching. Drop me a like, subscribe for many more. And as always, happy investing.